Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back to the Private Practice Survival Guide podcast. I'm your host, Brandon Seigel, and today I am joined by Sean Healy with Accounted4. Now, many of you know in season 2 of the Private Practice Survival Guide podcast, every week I'm bringing on different guests, etc. And you'll see my characters, so to speak, that I'm bringing on to this season's podcast are all about transforming the way that your private practice functions. So Sean and his team Accounted4 have been truly some of the most incredible partners for private practices that I support. They bring something that a lot of you need. They bring what I call is CFO coaching, where they're actually bringing you fractional finance authorship. They're really helping coach you on how to improve your bottom line, but then they're bringing technology and bookkeeping skills to another gear. And I want to be crystal clear. They're not that CPA. They're not that tax planner. They are the one that is making sure your numbers make sense. And together, Sean and I often are working hand in hand with him and his team to really build a transparency in your numbers so that we have data-driven decisions. So without further ado, Sean, I want to welcome you to the podcast, to our family, and I'm excited about this episode.
Well, Brandon, thank you for having me. As always, looking forward to our conversation.
Yes. So in this first episode, I was really, everything has intention, and I wanted to talk about cash flow, but one of the things that people don't recognize is this difference between cash flow and profit, and why sometimes our profit and loss is quote unquote lying to you or failing to you. And we recently have had some clients where the client will come to me and they're like, "Look, Brandon, I know that you're showing you collected more money than I've ever collected, but I can't afford to pay you." And Sean, you and I always game plan. And part of it is that people don't recognize the difference between cash basis and accrual basis and really the evaluation of true profit versus true cash flow. So I guess the first thing I want to throw out your way, Sean, just for you to give feedback from your perspective is, why are practices on paper showing profit, but then the owners can't even pay themselves, and what's that diagnostic process of like how we show profit while also valuing our role as an owner and practice administrator, et cetera?
Yeah, so it's a very common question that we get. It's actually the question that is what originally started me down the path of creating Accounted4. So before Accounted4, I was a director at an accounting firm, and I remember having a conversation with the client who kept being told that they were making profit, but kept asking, "But am I making money?" And when we finally dove a little bit deeper, his response was, "I'm keep being told I'm making all this profit, yet my credit card, it keeps having a higher and higher balance and I can't pay it down. I'm struggling to make payroll. I can't afford to pay myself. I'm being told I owe all these taxes, but I don't have money in the bank to be able to be able to make any payments on any of this. How am I so profitable when my bank account is not changing?" And so that really led me on a journey to better describe and understand that underlying problem. And what we found is there's really 3 languages of business, 3 languages in accounting. Your first one is profit, which profit is just the language of accountants. All right. Your taxes are based off of profit. So a lot of times they're going to have a pretty heavy focus in explaining your profitability or really talking solely around the profit and loss statement. Then you got EBITDA, which is the language of finance professionals, because that's what your valuation is usually based off of. If you want to go get financing, they're going to talk EBITDA. Then you got cash flow, which cash flow we have found is the language of business owners and entrepreneurs. And what cash flow is literally just, is my bank account getting bigger or is it getting smaller? Do I have enough money to make payroll, right? So I think where the biggest disconnect is profit and cash flow are actually two very different metrics. There's a lot of items that you have to spend money on that don't land on the profit and loss, meaning there are things that you have to spend money on that come after your profit. So the best thing that we have found is to help budget the 5 items that come after profit, which is many times your owner compensation, right? So if you're taking draws or distributions, your owner compensation comes after profit. If you don't make profit over the course of like a certain window of time, unfortunately, you can't take owner distributions. The other one is debt payments. So if all of a sudden I took debt out, I have to eventually make these debt payments. You do that with your profit. All right. Then there's savings. You need to make profit in order to start saving for things. You need profit to be able to pay for your taxes, which is number 4. And the 5th one is if you're ever buying assets. So if we have to go and pay extra money for a build out or put a deposit down on a new building, all those things come after your profit. So what happens is if you're not making profit in excess of those 5 items, that's why cash flow tends to be very tight, unfortunately.
Well, and as we look at this, one of the things that I find is something that often leads to the loss leader is practices that try to grow too fast. And you may disagree. It's like, hey, we're going to roll out 3 clinics, and they think that it's a race to win the profit game. And I have found that slow and steady wins the race. I don't know if you disagree, but like there's a point where sometimes you overextend yourself and the debt that you take on to grow. So on paper, you're like, look, Brandon, we're very profitable. When this all balances, I'm like, yeah, but your debt is costing more than your profit.
It depends how much runway you have, and it depends how much profitability you need. So if I want to grow very fast, you need to have a certain amount of capital to be able to invest, to be able to do so, knowing that, hey, this might cost us a bunch of our profit, maybe 10, 20% of our profit's going to paying down this debt. If that's part of your plan and you're doing it intentionally, that's one thing. I find that most people, when they start growing or they get into a hyper growth mode, it's generally not intentional. It's generally they felt like it was the next step or it felt like the progression, but they didn't plan for it from a cash flow perspective, and they didn't make sure that they had an excess of profitability to be able to afford that monthly debt payment moving forward, on top of, once again, the other 4 items that are going to impact your cash flow.
I think the other thing that I find common that's affecting cash flow, and you may disagree, is that some owners are taking or requiring salaries in order for them to make their personal family needs happen, but they're not generating enough revenue as an organization to support what they want to make or need to make. So I'll give you an example. Physical therapist, and let's say, physical therapist Terry starts a company. She needs $100,000 salary for her, but then she's only treating, give or take, 5 to 10 patients a week because she says, well, I got to run this and I got to manage this and I got to do all these things. And she doesn't recognize that the margin on her employees is not great enough for her to be able to afford to pay herself that salary for quote unquote 80% of her time being devoted to management, if that makes sense. And so what I'm finding is people's business algorithm, when they're looking at their profit and loss statement, it doesn't make sense because they don't recognize going into the practice that the average employee is only giving you under 20% of net differential, meaning that the money left over after I pay each employee's cost and the facility and all these other expenses, in a best case scenario, is 20%. So if they bring in, let's call it, $100,000 in revenue, and we have 15 to 20,000 left over, how many employees do we need just to make up the difference of PT Terry's salary so that she can work the business? And then she says, hey, Sean, and tell me if you hear this too, but it's Sean, I'm working so hard. I'm only making 100,000. I could make more money. And that's my point is your biggest asset as a clinician is to deliver revenue, not to manage your practice. And so hire someone that can manage your practice for less money so that you can deliver revenue. Any thoughts on that?
Yeah, I mean, I think every scenario is a little bit different. I think what we tend to find is most business owners, number one, don't have projections, so they can't see ahead. And if you can't see ahead, it's really hard to put a game plan together. But more importantly, they don't know their break-even number, right? I mean, I think kind of breaks into two things. If you don't know how many visits you need you and your therapists to see on a consistent weekly basis, not to get profitable, but to be cash flow positive. If you don't know that number, it's really hard to gauge whether you're having a successful week each and every week. I think you also brought up compensation. You're the master of compensation. Compensation is kind of it's a little bit of an art. It's a little bit of a science, depending on who you speak with. I think a lot of people get caught in the trap of paying what the employee wants to make, not necessarily what you can afford for them to make. And this is every state, whether you are in the mountains, whether you are by the beach, whether you're in the middle of nowhere, whether you are in a city, it is extremely, extremely difficult to compensate fairly and accordingly, and to do it in a way that you're still making profit and still making an ROI from those people. That's usually where you come in, right? That's where you can come in to help them build that appropriate plan. I think a lot of people get caught and they pay a salary they think they need to be able to get a certain amount of visits, but they don't see the correlation between I'm overpaying, I'm losing money off of this employee. It can get a little bit difficult if you're not looking at those numbers on a consistent basis. Or once again, the word you hear me say a lot is be intentional with what you're paying. Be intentional of the number of visits you're seeing. You need those benchmarks to be able to plan accordingly.
Well, and it's funny because you talk about the language of finance and accounting and all these different things. And for me, the language of an employee is how much are you paying me in wages? How much do I get to take home? That's really what they're focused on. But where we miss the mark is the language of total people expense. How much did that person actually cost us? And so often than not, we don't translate the numbers into a communication that makes sense to everyone. And sometimes the disconnect is the wage they want to make for the expense that it's going to cost the company doesn't translate to the revenue needed. And so that's where we have to be able to break up that component. The other piece that I want to kind of bring about, because I think it's really important with the diagnostic process of profitability and cash flow, is we often don't recognize the loss leader of profit when we work with a secondary and tertiary insurance. And so a lot of practices don't realize that if Sean comes in for care right now and I have to bill his primary, and let's say I get paid within 30 days from his primary, now I have to wait for the remaining part to bill out to his secondary. I wait another 45 days for his secondary to process. Then I get that back. Then I have to bill to his tertiary. All of a sudden, it's taken 180 days for me to get paid, quote unquote, maybe $100 in its entirety for that visit. It's not sustainable because every day that you don't have that dollar, it's costing you something, in my opinion. Do you agree?
Yeah, I agree to that.
And so sometimes what we don't recognize is we think we have more margin than we do, and we don't put a value on time. So sometimes actually taking less money and getting paid quicker is actually more cost effective than trying to make back margin with time. It depends, but you have to look at that when we're looking at this on paper. And I think this word kind of like fair and reasonable or living wage, we hear all these different things. And I come back to we are contracting for a fee for service. That fee for service does not take any form of living expense into how they define what they're going to pay for that service. So you as a practice owner have to look and see, can you deliver the service at that fee for service and make a profit? And does it deliver at a fair and reasonable level for the people that want to work in this world? And so sometimes we're creating qualitative goals and quantitative goals that contradict each other, is what I'll say.
And sometimes it's not possible.
Yeah. Yeah. So you and I both see a lot of practices that struggle. Unfortunately, in our world, we deal with people that are already in pain, not trying to prevent pain, typically. Would you agree? And so, what's the one number practice owners should check daily that predicts financial trouble 90 days out? Is there anything that you see that you're like, hey, if you're checking this daily or weekly or whatever, it's going to protect you 90 days from now? Is there something that you tend to coach practice owners on around this?
So I'm going to double down on an answer I already gave. Your visit number is by far the most important number, but it has to be in comparison to your break-even number, right? So if you don't know your break-even number, it's really hard whether to tell or whether to gauge whether you are winning or losing each month or each week, right? I say always make sure to look at your visit number each week. If you're not sure what that number is, that's generally problematic. And if you want to take it one step further, make sure that you are looking at how many visits you have scheduled the next week. Because if you see how many visits you scheduled and you factor in what your general cancellation rate looks like, you can tell in advance whether you are about to have a winning or losing week. As long as you can keep that general, as long as you can stay over that break-even number, even if marginally, you can stay over that break-even number on a consistent basis, what will happen is you'll eventually get profitability. And then that profitability, when you factor it into the break-even number, should be in excess of all those other items that come after profit that we talked about earlier. So once you have that number, as long as you're hitting it consistently, you're going to have ebbs and flows in your revenue. It's just how insurance companies work. Some pay you on certain days of the week. Some weeks or some months have more business days than others. You're going to have ebbs and flows. But if you can keep that consistent metric week in, week out over that break-even number, it's a recipe for success.
I totally agree. And one of the things, so what I do in my own practice is everything is measured based on daily average. So whether I have 22 days, 20 days, 18 days, 21 days, if we have a longer month, I don't celebrate like, oh my gosh, we had more hours. This was our best month, because in actuality, we may actually have done worse because our daily average was lower. So for me, everything is communicated through the lens of what was our daily average, what was the daily reimbursement value per visit delivered, and then typically what we'll do is we'll say, what was the daily plan of care delivery? So if I had 50 appointments on that calendar, what did we actually deliver on a daily basis? So we're averaging a 95% quote unquote arrival rate per day. We are averaging 138 visits per day. We are averaging 78 billable hours a day, whatever that is. And that is going to help just really track day-to-day performance, because you may have a poor day. What we're looking at is if we've had 5 days, we're doing our total visits divided by 5 days to get that daily average in those margins. And that's going to help us track consistently month over month, because now we're not tracking, hey, 22 versus 20 days between months. We're just tracking, hey, we did 168 billable hours per day in January. In February, we actually were able to deliver 170, even though there were less days in the month. So our daily average, actually, we had a better month in February when looking at that. Any concerns? Are there any KPIs that you see that often mislead practice owners, where they get caught in traps, or anything that you're seeing where you're like, oh my gosh, don't look at that because it's giving you false data?
The amount that you're billing. I'm really happy for you that you billed $300 for a visit. You didn't collect that $300. Unfortunately, it is a little bit of a it's extremely a made-up number. I would say that don't consider that a win when you build a lot. Focus it a win when you've collected a lot, because you got to take it to the bank for it to actually mean something.
Yeah. And it's so funny because someone reached out to me and about our billing services. And I said, well, what's your average, like how much are you collecting? Like, what's your revenue? And they go, oh, we're just over 8 million. And I was like, okay, that's a large practice. And then when we went into I quoted them based on 8 million. And when I looked at it, they were actually at 3.8 million. They were over 100% inflated. They're like, oh, well, that's how much we're charging. I go, your charges is an imaginary number, just like Sean said. That is not reflected. And that's why for me, typically what I try to do is I say, let's take your highest allowable and let's add 25 to 30% above that. Like, let's keep our charges as close to the allowable as possible. And so that's my feedback on that. And so my last question for you for this episode is, how do you explain the balance sheet to practice owners who are only looking at their bank account? Like, how do we help them understand what a balance sheet represents?
So here's the hard part. The balance sheet is what I always refer to as the forgotten financial statement. So your P&L is a measure over a window of time of performance, whereas a balance sheet is really a snapshot of just the basic accounting equation. And the hard part with the snapshots don't show progression. So a lot of people tend not to look at them, especially finance and accounting professionals, right? So kind of going back to the beginning when I said there's 3 languages, something I want you to be aware of. There are 5 different categories in accounting that every account falls under these 5 categories. You have your income, you have your expenses. That makes up your profit and loss. 2 of the languages, EBITDA and profit, land on that profit and loss. So what happens is a lot of finance and accounting professionals focus almost solely all of their time and energy on how your P&L went, because those are the 2 metrics that matter to those professionals, as they should matter to those professionals. The hard part is there are 3 other categories. Your assets, one of which is the bank account, which you're staring at every day. Then you have your liabilities, which are things that you owe. And you have your equity, which is what you as the owner are entitled to. The funny thing is those 5 categories that come after profit all land on the balance sheet. So when we look at your owner distributions or draws, that's equity. That's one of the categories on the balance sheet. When we look at your debt payments, that's a liability that lands on your balance sheet. When we look at savings or asset purchases, those are other assets outside of your bank account, but they are still things that you own. They are still assets. Once again, they land on your balance sheet. And the final one is taxes, which for most people that are listening, it's really just an equity draw that you're taking out as taxes to make payments on your personal behalf. What happens though is there's all this money that you're spending coming out of your bank account that's just going to either pay off or impact something else on that balance sheet. But because it doesn't show progression, it's not easy to see the impact of it over a window of time. So having somebody that is constantly looking at the balance sheet or can educate you on the balance sheet is very, very important, because once again, planning for a certain profitability number is great and it's important, and you should have a focus on that. But what you do with that money is just, if not even more important, because it's really hard to know how much profit you need if you don't have those other 5 areas budgeted and accounted for. So Brandon, I always give the question, I do this in a lot of my presentations, how much profit do you need to know that your business is successful? And most people raise their hand and they're like 20%. And don't get me wrong, that's usually a pretty good number. I always like to challenge and say, you need enough profit to get you to your goals to pay for those 5 other areas. If you don't know how much you need to make in profitability to be cash flow positive, that's always the starting point from our opinion.
Yep. Yep. No, I love it. I love it. So obviously, many of you are like, oh my gosh, I need help. Sean, how do we get in touch with you?
So you can always look me up online, Sean Healy, Sean, the Irish way. You can always shoot me an email, shealy at accounted4, the number 4, llc.com, or you can go to our website and fill a form out for us to be able to reach out to you. Either way, what we always like to do for anybody that has any interest is we always do a free analysis. We always like to be able to share what the story that your numbers are telling us. We just found that it's best to educate first, before choosing to go in any direction. We always want to make sure that everybody is aware of what their numbers are telling us, and just so that you can make better decisions regardless of whether you move forward with us or not.
Awesome. Well, I appreciate that. It's also in the show notes. Thank you, Sean, for being part of our episode. And thank you for tuning in to the Private Practice Survival Guide podcast. Don't forget to like us, subscribe, follow us on Instagram, LinkedIn, and all over. Together we can thrive, not just survive. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you love this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.